Hello everyone, welcome back. This is Accounting 210. We are continuing with Chapter 10, Performance Evaluation. So today we talk about the budget, right? We talk about flexible budget and also the variance. So last time when we talked about the first part in Chapter 10, we said how do you evaluate the managers, the performance? You have to have a benchmark. You have to have a budget. So you compare your actual with your budget. You can know you are doing better or you are doing worse. We say we always put the actual on the left side, and then we put the budget on the right side. We also say, because we are accounting students, we don't call this as a difference. We have a fancy name called variance. And it can be favorable or it can be unfavorable depending on specific situation, right? You cannot say, hey, larger number is favorable. But that's the general idea. So look at this table. I want to go through this table with you. We have this master budget, and you also have something called flexible budget. But we go with the master budget first. We learned this in chapter 9, right? We learned this in chapter 9. You have this master budget at the beginning of the year. So let's say January 1st, 2020, you made this master budget. And you thought, oh, you will sell this, you will produce this, remember cash budget, capital expenditure budget, so those things. So let's look at this one is from your chapter 9. For the January 31st, you made this budget on January 1st, 2020. So you have your sales revenue, you have your sales volume, sales revenue. Remember we said each case we sell at $20. You have a variable expense. You got your contribution margin. You have a fixed cost. You got your operating income. So the first column B is the actual number. And then you will also have the master budget. As I say, you put your actual first. You put your budget second. And then the variance, we call it a master budget variance. We can also do it as the percentage, but I don't really think I will test you, so you can convert your variance to the percentage. But as long as you know the variance is the difference, so you just use the variance divided by your number, you get a percentage. So we focus on column B, column C, and column D. Remember we said we thought we budgeted at the beginning of the January, we budgeted we will produce 30, we will sell 30,000 units, right? We will sell 30,000 units. So our units, we thought we will sell 30,000 cases. But actually we sold 32,370 cases. Is there any variance? Yes, right? We sold more cases than we thought, which is a good thing. So we will have a favorable 2,370 units. And then you also have a sales revenue because each one is $20. So our units is more, our revenue will be also more. So we have a favorable revenue variance. Look at the cost. Look at the cost. You thought your cost of goods sold will be 360,000, but actual is 391.540. Your actual is larger than the budget. Your actual is larger than the budget. You will say, oh, larger is better, so it's favorable. Isn't that right? No, because we are talking about a cost. So actually you cost more than your budget. So you have a variance of $31,540, but it is unfavorable. Does this make sense, yes or no? And then you do all the things, you get your contribution margin. You thought it will be 130,200, but it is 144,024. So you have a favorable contribution margin. And for the fixed cost, okay, for the fixed cost, some of the fixed cost, they will be zero, because no matter what, no matter your units the same or not the same, fixed cost is fixed, so it's zero. But in your textbook, when you have a zero, you think it's a good thing. So zero, personally, I don't really know it's good or bad, but your textbook put zero as favorable. So if you do my accounting lab, make sure zero is favorable. And then you compare your operating income. You thought the operating income will be 97,200, but actually it's more than 100,000. So you have a favorable operating income variance. Nothing really much. I just want to go through this table with you to get some idea. And then we will introduce one new concept called flexible budget. So what does the meaning of a flexible budget? Master budget is also called a static budget. It's based on the beginning of the year, your budget. But flexible budget is given the actual units. And do the budget. Okay, so let's look at the flexible budget, the concept. It's prepared using the actual volume. It's the budget managers would have prepared at the beginning of the period if they had a crystal ball telling them the correct volume cases. A flexible budget allows managers to compare actual revenue and expense with that what they could have expected given the actual sales volume. So you will say, oh my goodness, what does that mean, right? Your English is better than me. I should ask you this question. I know all the words in this paragraph. I'm not really sure what this paragraph really want us to say, but don't worry. We look at this table and then we do some practice. Okay, so now you have this table. It's kind of have a more space, right? So you still have this sales volume. You have your revenue. You have your variable cost. You have contribution margin. You have fixed cost. You have operating income. So what do we have? We already talked about you have this actual. So it's exactly the same. 106,944, 106,944, nothing really fancy. And then we also have this master budget, 97,200, so nothing really fancy. What we have in the middle, we call it a flexible budget. So we put one, I would say, hybrid number. We call it a hybrid number in this middle. So what's the main difference? Look at here. The main difference is in this row 6, sales volume. At the beginning of the year, so you have this master budget at the beginning of the year, January 1st, 2020. You got your actual January 31st, 2020. You also do your flexible budget January 31st, 2020. So your master budget is everything about your budget. You thought you will sell 30,000 units at the price of $20 each. So you got this 600,000. You thought you will sell 30,000 units and each one is $20. It's your budgeted units times your budgeted price. Your actual is you actually sold $33,370, right? So you actually sold 32,370 units. Let me look at the, give me 1 second, I figure, sorry, I'm kind of confused myself. See, you need to prepare, right? If you don't prepare, you will not get the right answer. So your revenue is this. You saw 32,370. Okay, so see, this is my question. Okay, so this is my question. Your total revenue, your actual is 605,374, and your actual unit is 32,370. So your actual selling price is $20 but 2 cents. So your actual selling price is $20.2. So remember this one. Okay, so your actual unit is this unit. Each selling price is $20.2, and you get your sales revenue. So your actual is actual units times actual selling price. And the flexible budget is you use the actual units. But time your budgeted dollar amount. You will say, Professor, I don't know what do you mean? Okay, so what does this mean? You use your actual units. What is your actual units? You use your actual units. 32,370. Remember, you use your actual units, but we time our budgeted selling price. $20. So you get the number 647,400. 647,400. How do you get this number? It's your actual units. 370 times your budgeted selling price, $20. How do you get your actual results? Is your actual unit 32370, but we time your actual selling price, 20.20. Okay, look at this table one more time. Your master budget is your budgeted units times your budgeted price. Your actual is actual units times actual price. Your flexible budget is a hybrid. Your flexible budget is your actual units, but we use the budgeted price. So your flexible budget is a part actual and a part budget. Your master budget is both budget. Your actual is both actual. So personally, the way I remember is actual revenue is your actual units times your actual price. Your master budget is your budgeted units times your budgeted price. And your flexible budget is actual units but times your budgeted price. So it's actual times actual, budget times budget, but flexible budget is hybrid. It's half actual and half budget. Okay, I stop here. I don't want to make a too long video. I stop here. We finish this table together. I point out something, as I say, it's related with the chapter 11. So don't cry if you feel, oh goodness, kind of didn't get it. Do not worry. We do some numbers. We practice more in chapter 11. Thank you.